Are you investing in the US stock market, hoping to secure a comfortable retirement? What if I told you that over the next decade, US stocks could potentially stagnate, leading to disappointing returns? Goldman Sachs is warning of this scenario, and in today's video, I'll explain why. Most investors believe that investing in the S&P 500 is a safe bet, delivering consistent returns over time. And historically, that's been true, about 10% annually on average when you reinvest dividends. But what if the next 10 years don't follow that pattern? If you're preparing for retirement or managing a portfolio, this video is a must-watch. According to Goldman Sachs, the annual nominal total return of the S&P 500 over the next decade could drop to just 3%, much lower than the 13% average of the past 10 years. And after adjusting for inflation, the real return could be as low as 1%. They estimate a 72% chance that US stocks will underperform government bonds. So, why this bearish outlook? The first reason is the historically high valuation of US stocks. The CAPE ratio, an adjusted measure of the price-to-earnings ratio, currently stands at 38. While not as extreme as the dot-com era, it's still way above the historical average of 22. And when CAPE has been this high in the past, it often led to long-term stagnation, just like in the 1960s and early 2000s. The second reason? Market concentration is nearing a century high. Today, just 10 companies, including the Magnificent Seven, make up 35% of the S&P 500's total market cap. History shows that when market concentration peaks like this, the overall market often struggles. If these mega-cap stocks slow down, the entire index could face a significant drag. Lastly, long-term interest rates have broken a 35-year downtrend, signaling the start of a potential long-term uptrend. Higher interest rates often lead to more frequent recessions and can compress stock valuations, making it harder for stocks to grow. Over the next decade, this trend could severely impact the S&P 500. Goldman Sachs predicts that while US stocks might hit new highs in the short term, the long-term outlook over the next 10 years remains grim. However, long-term stagnation can also be an opportunity. If you continue systematic investments, you could build assets for the next economic expansion. But if you're looking to maximize returns even during this period, it might be worth exploring alternatives like emerging markets, gold, or even Bitcoin. If you want to stay ahead of market trends and understand the best strategies for the upcoming decade, hit that subscribe button and don't forget to like this video. Let's navigate this uncertain market together and find the best ways to build wealth, regardless of where the US stock market heads.